All right. What do you say, Al? I think we got
I am ready.
a minute after we get going here. I know we've got a lot to cover, so let's do this. So thank you for joining us today. This is Jason Dahl. I'm a certified financial planner and a partner at AFS Financial Group. I'm here today, of course, with my colleague Alp Adebeck, the founder and managing partner of AFS. Alp is going to lead most of today's presentation as the resident former CPA tax guru. What do you say, Alp? That was your fourth favorite day of your life? Your last day of doing taxes?
Might have been the first. Huh?
Might have been. So before we get going, I know we have folks tuning in from the AFS 401k side today. So as a quick reminder, we at AFS Financial Group operate as a separate entity from the AFS 401k Retirement Services team, but we often collaborate, especially when it comes to our financial wellness programs, such as today's workshop. Today is our last session for this year's monthly workshop series. It's been another stellar year of educational sessions filled with great audiences like yourselves. So thank you for tuning in throughout the year, and please reach out and let us know if there are any topics you would like us to cover in the coming year. Lastly, as always, for today's session, please ask questions at any time. You can ask a question by typing it into the Q&A link on your screen. Hopefully everyone is familiar with that by now. I imagine this isn't your first Zoom call. So please don't hesitate to type in any questions at any point. We'll either address it right at that moment, or if we know we're going to cover it later, we may just hold off a moment. But probably my favorite question is, can I schedule a time to speak with you, Jason or Alp? And so we want to encourage you to directly follow up with us after today's session if you have further questions or would like to schedule a time to review a few things over Zoom or the phone or even in person these days. So as I like to say, we definitely love what we do, and the best part of what we do is connecting with folks like yourselves and helping you solve personal financial planning puzzles. So don't hesitate to reach out, or if you know of someone who might benefit from putting in touch with us. So without further ado, let's cover some 2022 year-end tax planning strategies. And of course, we've got the obligatory disclaimer slide up front. This presentation is not meant to give anyone any specific tax advice during this presentation. I always encourage you to consult with your own tax advisor and or estate attorney, because there are a number of crossover topics between estate planning and tax planning in today's discussion. If you're listening to the recording, please note that this information is as of November 2022. And we were just talking ahead of time. I always like to comment that if you do your own taxes, if you don't hire that out, use software. I don't know. I feel like every now and then I still hear of somebody who does it manually. It's getting fewer and fewer, but it's so complicated, and there's so many different calculations that need to be run potentially to use software. I want to encourage folks.
And I would say that all the softwares generally take you through things that you may not think about, and that's
Right.
probably the best benefit. Like, oh, I didn't realize that was deductible, or I could get a credit for that. All right, well, thank you, Jason. And for those that Jason kind of hinted about a little bit, but I used to do a lot of tax work in my younger days. I got out of the tax business in the year 2000. And I will jokingly say, I think at times they say getting married and having 2 kids, those were the 3 best days of my life. But I can say at times getting out of the tax business it's up there. Today we'll go over the basics, types of income, deductions, credits, and some year-end strategies. And so we all know about federal taxes, but when it comes to state taxes, most of us forget that there are 7 states that do not have a state income tax, and we have them all listed there. And for fun, this is kind of stuff that I do for fun. I was actually looking at some of our what we call the JP Morgan Guide to the Market slides, and they talk about home price appreciation year over year. And I looked at it the other day, and they measured it from August 2022 back 12 months. The 2 areas, the 2 cities that had the greatest price appreciation, and they've had it, I think, for a while, were Miami and Dallas. So obviously cities and states with no state income taxes. And a lot of this became, I'll say, more popular after the 2018 Tax Cut and Jobs Act, where you were limited on how much you could write off on your state and local taxes. It was capped at $10,000. So a lot of high income businesses, financial service firms are starting to move offices down to Florida. When I say financial, so I think I'm talking about the JP Morgans, the Goldman Sachs. They're starting to
Private equity firms.
moving their offices down there.
Or on the East Coast, certainly a lot of folks going to Florida, and then of course a lot of folks going from California to Texas and somewhat to Nevada as well. But
a lot of businesses.
a lot of moves there. Yep.
Yeah, I think Elon Musk might be one of the famous California people that went to Texas and just said he had enough. And Texas, compared to California, obviously free in Texas. California, I think state income taxes are well over 10%.
I'm not hearing quite as many moves to South Dakota.
We have people that live in Alaska, right? So
Washington State
and Nevada, without a doubt. Nobody that I really know of in Wyoming, though. So on the next slide, types of income. Everyone's familiar with the main one. It's ordinary income, and that's wages, interest income, dividend income. And you could have, I'll get to dividend income in a second to expand on a little bit. Business income, Social Security income, retirement income, rental income. That's the profits after you write off all your rental expenses, unemployment income. So those are all examples of ordinary income, and that gets taxed up to 37%. So whatever tax bracket you're in, your last dollars of wages or all this ordinary income will get taxed in that bracket. On the next slide, we've got qualified dividend income, and that actually gets special tax treatment. So if you recall, when they talk about the tax law, Warren Buffett will always point out that he has people that work in his office that pay a higher tax rate than he does, because Warren Buffett's income, a lot of it is from qualified dividend income and from long-term capital gains. Both of those are capped at 23.8%. And so when you get your year-end dividend statements from your investments, you'll actually notice that you'll see something listed as total dividend income and then qualified dividend income. The qualified dividend income will only get taxed at the highest rate of 23.8%. You'll go through 15%, 20%, and then above a certain income level, the Affordable Care Act, I'll call it Medicare tax, kicks in, which is an extra 3.8%. So that's how you get to that 23.8%.
And this hasn't always been the case, right? Out there,
that's correct.
Qualified dividend income used to be taxed as ordinary income. I want to say it switched to this around 20 years ago or so.
And some people would argue, well, why do wealthy people get a break on it? Because they might have more dividends. The reason that dividends actually should get some type of tax break is dividends are an after-tax disbursement from corporations. So if you're getting dividends from Procter & Gamble, they are not writing off the dividends on their corporate tax return. And so the argument has been that if it's now being taxed by individuals, technically that money's being double taxed.
So, for another conversation, there are plenty of things that are double taxed.
And so when it comes to capital gains income, you can actually, on long-term capital gains, assets held for more than a year, you basically get 23.8% maximum tax. If you have short-term capital gains, so if you bought something and sold it 9 months later, that will get taxed as ordinary income, which means that whatever bracket you're in, that's what you'll pay tax-wise. But so big tax breaks with cap gains and qualified dividend income.
Yeah, and then we've got here the 23 brackets. So forgive.
You skipped ahead, I think.
No, we had.
Somehow it slipped.
We got the 22 tax brackets.
There you go. Thank you.
Yep.
And so what we're trying to show you here is how our tax brackets work. And in the US, we have progressive tax brackets. So you actually go through all the lower tax brackets. So for example, if somebody's making $300,000 of income, they will first go through the 10% bracket, 12% bracket, 22% bracket, 24, then 32, and then their last dollars will be taxed at the 35% bracket. The amount of income over $215,950 will get taxed at the 35% bracket. So to distinguish that from what people talk about a flat tax. If it was a flat tax, everybody would just get taxed at the same rate. So if they have a flat tax, if it's 18%, then everybody's income would just be taxed at 18%.
Every dollar is taxed at the
Yep.
same rate. Yeah.
Yeah, I know in the past, maybe 2 or 3 elections ago, somebody was proposing, a flat tax again, and they might have had 2 brackets actually. So like a bracket at 15%, then another one 18, whatever it was. But that's really the
I
distinction.
think we missed Steve Forbes running for president. He was the one that always talked about the flat tax.
Absolutely.
And Alp, I think where folks will see this a lot of times when they file your tax return, most tax returns, when it spits out, they'll show you, okay, what was your marginal rate? And then what was your highest rate, right? And so, okay, if you had, in Alp's example, 300,000 of taxable income, okay, your highest rate was 35%. You paid 35% on some of those dollars, but you went through all those brackets. So the marginal rate was sort of like the average of what you paid.
Correct. And I'm curious if you got this. What do you go? Should go to the 2023
yep.
brackets.
Yeah. Sorry, I got a little trigger happy earlier.
Yeah, so all we're showing you here is next year the brackets have been adjusted for inflation. And so just as Social Security payments have gone up a decent amount for next year, I think they're going up 8.7%. They've indexed up the tax bracket. So this has been helpful. So the reality is people will pay less tax. If their income goes up 5 or 6%, they'll actually pay a little less tax because the brackets have been indexed up.
So you can see, right, the 10% bracket next year is 0 to 11,000. This year it was up to 10,275. And so you'll just see every number going up.
Go ahead.
Yep.
There you go. So the standard deduction. So what this actually is I'll give you an example. So let's say somebody has $100,000 of wage income and no other type of income, no capital gains, no dividends. They actually won't pay tax on the $100,000. The government gives them automatically a standard deduction. So if they're single, they get a free $12,950 deduction. So they'd only get taxed on around $87,000 of income in that really simple example. If it's a married couple and they have $100,000 of total income, they're going to get $25,900 of a standard deduction. And that actually can increase when you're 65 and older. They expand these standard deductions. So fairly straightforward. The government basically just says, you get this amount of deduction. It eliminated, so they raised the standard deductions tremendously in 2018, and it eliminated millions and millions of people that used to itemize their deductions. The standard deduction for them is now larger than their itemized deduction, so it simplified a lot of tax returns. I think the next slide actually shows you that the standard deduction's going up next year. Again, same concept. It's been indexed up for inflation.
Just to clarify, I know we're going to talk about credits later, right? So this is different than a tax credit. This is a deduction, right? So just reducing your taxable income by this deduction amount, whereas a credit is more valuable, and we'll talk about that in a moment.
Correct. So when it comes to a standard deduction versus itemized deduction, in the old days, if you bought a house, you automatically itemized your deductions. And I'll hesitate and say, in today's low interest rate environment, because obviously that has changed, but for people that had refinanced their loans to, on a 15-year loan down to 2% and, 30-year loans at 3 or below 3%, they didn't itemize as much under the new tax law since 2018, just because their mortgage interest deduction was so much smaller. But when you itemize, these are the deductions that count towards itemization: medical expenses, state and local taxes, that's called the SALT deduction, mortgage interest expense, investment interest expense, charitable contributions, and miscellaneous itemized deductions. I'll go through those on the next slides. Medical expenses, fairly straightforward. Anything that affects your body or your mind except cosmetic surgery. So if you are itemizing, to qualify for medical expense deduction, you compare your adjusted, you take 7.5% of your adjusted gross income. And it's funny, I used to say that was the last line on the old tax forms, but now there's so many different variations of the 1040 tax form. But there's a line on the forms now that says This is your adjusted gross income. You multiply that by 7.5%. And so if somebody's income was $100,000, 7.5% is 7,500. If you've got medical expenses in excess, in this example, of 7,500, they would count towards your itemized deductions. What usually gets people over the threshold of so they can write off medical expenses is large dental bills. And I'll say things like assisted living, nursing home, that usually opens up the deduction. We've had a few people that were self-employed that paid enormous amounts for health insurance premiums. That also helped them out in this scenario. But some of that basically got reduced a little bit with the Affordable Care Act. But one thing I want to point out, if somebody has large nursing home expenses, that can open up a lot of planning opportunities. So if you have a spouse that's getting some type of assisted living or is in nursing home,
Or a
if you're taking,
parent.
if you're taking care of your parents' taxes and you know they're in a nursing home and paying $10, $12, $15,000 a month for their care, those all qualify net of any type of long-term care insurance reimbursement or net of any type of insurance reimbursement at all. The amount of those expenses basically count as medical expenses. And so we've had people with enormous expenses here that wipe out all of their income. And the example I'll give is, let's just say somebody has, $100,000 of income, but they might have $150,000 of nursing home expenses. And so they actually have $50,000 of negative taxable income. There are some planning opportunities there. This actually happened for my dad's situation before he passed. He was in a nursing home, and we were able to pull money out of my dad's retirement account without any tax consequences because he had negative taxable income. So for example, if he had $50,000 of negative taxable income, we could take $50,000 out of his IRA without any, I'll say an additional 50,000 over
Additional,
above the
yeah.
RMDs without any tax consequences.
So
So
accelerating
really,
income.
absolutely. But in theory, accelerating income that turns out to be tax-free income.
Right. And taking a step back, I also believe if someone is paying annual premiums on a long-term care insurance policy, those premiums paid are added to
small portion of that.
It's a
There's
portion,
a
right? Yeah, there's tiers. Yep.
So you'll have to go through a calculation to see how much of your long-term care premiums potentially can count as medical expenses if you qualify. Again, it's rare that people get this except for large dental bills and large nursing home, et cetera. State and local taxes, you can now, you're now capped at $10,000. So if you're a high earner and you're in a state with high real estate taxes, you could have $40,000, $50,000, $100,000 of these expenses, and it's capped. Your deduction is capped at $10,000. That's why I was mentioning earlier, some of the tax-free states became a lot more popular when they put this cap on. And there's stories from some hedge fund people that had $1 billion of income that moved out of states like Illinois and New Jersey and actually blew holes in the state budgets just from one person moving. They might have lost out on $100 million of state income taxes. Really fascinating. Now there's a little bit of a workaround that's been around for a couple of years. So there are some states that were high state income tax states that allowed what's called the owners of pass-through entities, certain types of business entities, to write off state income taxes through their businesses. So a complete workaround. It's in Maryland, and it got passed in Virginia and got clear. There was a clarification issue last year in Virginia, but I think that did get cleaned up. And the example is if the business owner pays $30,000 of state income taxes, there's a formula where they'd actually pay it through the business and they're able to deduct it. And it's interesting, I was at a conference a year ago and I brought this up to somebody that I thought it might apply to just to see if their accountant had told them. And the person said, no, I've never heard of this. And this person was a really high earner. And I believe it got him an extra couple $100,000 tax deduction, literally just for a 2-minute conversation. So if you have a pass-through entity, talk to your CPA if you're not already doing this.
Absolutely.
Next slide is mortgage interest. Really got fairly simplified here. So if you buy a new property now, the largest amount of debt that you can deduct the corresponding interest expense on is $750,000. So this is for homes purchased after December 16th, 2017. You're grandfathered in. If you had bought a home before that date, you can write off $1 million of mortgage debt. And so, for example, if you have a $1.5 million mortgage, there is a formula to determine how much you can write off on your taxes. The first 2 years when they had this out, a lot of the individual tax software programs hadn't figured out how to do this in an automated basis. I think now they have you enter in your beginning mortgage balance and your ending mortgage balance at the end of the year if you're over these thresholds, and I think the software will automatically calculate it now. But this applies to your personal home, so your primary residence. If you got a vacation home, it's cumulative. So if you've got $500,000 of mortgage on your primary residence and another $500,000 on a vacation home that's not being used for rental purposes, you're capped at that either $750,000 or $1 million limit. It has no relevance if you've got business property or rental property. Those are written off on separate schedules, and the cap is not applicable there.
Written off against any income from those properties.
Correct.
Right. Now, got a question here just to clarify that, the dates here, the 12/16/2017 date, it is purchase, not refinance, right? A refinance.
Correct.
Right. Yep.
Correct. And there was something that if you had been under contract
right.
of a property before December 16th, and as long as you closed before a certain date, it might have been February 15th, I'm making up the number there, you actually qualified for the larger amount. So there are some people that can circumvent this a little bit and get to the $1 million deduction, even though they didn't purchase the house until a later date. Investment interest. So this is if you're borrowing money to buy stocks, or if you borrowed money to buy investment land, raw land, so you don't have any rent coming in. You can write that off as investment interest expense, but it counts as an itemized deduction. So you actually have to itemize. If you don't itemize, it's somewhat irrelevant. And the way investment interest is written off, it's first offset, excuse me, against your current investment income. So if you've got $15,000 of dividend income and $5,000 of interest income, you've got $20,000 of investment income. If you had $23,000 of investment interest expense, you can write off $20,000 of, so they offset each other, and the additional amount gets carried over into future years. So you can continue to carry it over until you have years that you have larger amounts of investment income. And you can also make a special election if you've got capital gain income. You can actually have some of your capital gain income treated as ordinary income. So for example, if somebody had $100,000 of capital gains and they had $10,000 of investment interest expense and no other investment income, they can have $10,000 of their capital gain treated as ordinary income, and it allows them to write off their investment interest expense. The software should ask you that question, and if you've got a good accountant, they will know that automatically. Charitable contributions, fairly straightforward, no real changes here. I know we had a question on something, but and I'll get to that in a second, but you can have charitable contributions that are paid by cash, check, credit cards. These days, you'll notice that you generally get a letter from the charitable organization by the end of the year that says, sometimes each time you make a donation, but if you're a member of a church, synagogue, et cetera, they'll do it at the end of the year saying you gave 3,000, 5,000, 10,000 to the charity. You now have letters from all of them that if you do get audited, they are going to want to see that. I think the government was trying to send a message that they felt a lot of people were writing off charitable contributions in excess of the amounts that they were getting. So now when you get those letters, I think people tend to be a
Show
little
some
bit more
evidence.
accurate. Right?
Yeah. And in a similar vein, the in-kind donations. I know that over the years, there's been the IRS has started to pay a little more attention to the value that you put on the the box of old clothing that you donated, or cars. I know the cars was a big one that you actually, if you donate a car, I know a lot of charities do that. You need to wait to find out what the charity actually sold the car for to determine the value.
Yeah, in the old days, somebody would just say, "Oh, Blue Book value was $8,000." They would take that as a deduction, and maybe it's a car that wasn't running,
Right.
and they'd happily take that $8,000 deduction. And now, if the organization sells it for $1,500, that is what actually is sent back to you as what your deduction is.
A little teaser here, number 3, appreciated securities. So we're going to cover that in a little bit more detail in a moment. A great strategy for charitable giving for certain folks. And Alp, you mentioned that we did get a question sort of related to the charitable contributions in 2021. I think it was just a 1 year.
I might have been
or was
2
it
years, and it got
20
expanded in 2021.
Okay.
I think it got pushed up to 600, but so go on.
Yeah, there was a special charitable deduction of $300 for single filers or $600 for joint tax filers.
For those that didn't itemize.
For those who didn't itemize, exactly. So as long as you gave any amount to charity, even if you didn't itemize, you got to take this additional deduction, $300
I think they
or
were
$600.
originally were doing that to try to encourage charitable contributions
during the pandemic.
Yep. However, we mentioned that this is all as of November. At times they will come back in and say, yes, retroactively for the whole year, we're going to allow this to come in. We know there are certain things that potentially will pass by the end of the year. And so it's a question, will somebody sneak this in and allow people to do this? But for now, all of our research, it was a great question. I actually did not realize this, but it's a great question that was asked, that it's not allowed from what we've seen so far.
Yeah, as of printing today. All right.
So miscellaneous itemized deductions, they've been eliminated since 2018, except for gambling losses used to offset taxable gambling income. And I'm guessing everybody on this, I think, was a California resident that won the $1 billion cash payout. So that actually would qualify. So in the old days when I did taxes, I had somebody, I'm fairly confident it was in 1984, they won the lottery. It was in Maryland. And what was interesting is he did not know from the day of, I think it might have been a Saturday drawing, he did not know from that time until Monday how many people actually won the lottery. So I don't think they had that technology in place. And so it was a $6.5 million win. Unfortunately, 5 people total won it, but that particular person,
or fortunately for those other 5 people.
Unfortunately, it was actually one of my tax clients, because I remember it well. He got $64,000 a year, and back then, so he was a government employee, so he basically had doubled his salary by winning the lottery, and he would get a W-2 every year for the $64,000. And so we looked it up, and we saw no reason that he couldn't use that $64,000 to kind of offset his now becoming annual trips to Vegas to have a little fun. So if he lost money, he kind of turned it into tax deductible vacations.
So you turned him into a gambler, Alp.
I know, I just brought it up. He turned it on his own. But so when do you itemize? So we talked about the various deductions. Essentially, you just add them up and you compare them to the standard deduction. So the example we have on the screen right now, married couple, their standard deduction is $25,900. They're capped on the SALT taxes at $10,000, mortgage interest $10,000, charitable contributions $2,500. So they've got $22,500 total. In that example, they're going to take the standard deduction. So they're going to take the 25.9 versus the 22.5. And what's interesting here at times is most states will say you can't itemize on the state unless you itemize on the feds. And so that is really interesting. Some people at times might have, let's say in this example, they might have $25,300 of deductions. And if they actually had another $700 of deductions, it opened up itemized on the states, and the states didn't get as generous as the feds did with the standard deduction. So in those examples, if you're really close, you want to double check where you are, what state you're in, and would it be advantageous in theory to give an additional $1,000 to charity and maybe open up a large amount of itemized deductions on your state taxes at a lower rate? You have to factor out the formula.
But even in this scenario, to your point, just to clarify what you're saying, Alp, in this example, if this were real numbers for somebody, you can still choose to itemize on the federal return. Even you're not forced to take the
Correct.
standard.
You can make elections, but then you have to look at your tax bracket. So in that
see
example,
if it's worthwhile.
In this example, you gave up a $3,400 deduction.
Right.
By not.
Yeah, that delta, you're probably not going to make up that difference on the state. Right. But if it's in your earlier example, if it's a smaller differential. Yeah.
But a good accountant, if they're close, their software should alert them to this possibility that, oh, by the way, if they itemize on the feds, they might get a larger deduction on the state.
And Alp, I know we're going to talk a little bit more about charitable contributions in a moment, but just take this opportunity. So the SALT deduction, as you already pointed out, that is capped. That is a hard limit. You cannot take a deduction above that amount. These other ones don't have the same kind of hard cap, but there are some limits on charitable contributions. If you want to just kind of
sure. So it's your software again will ask you if you're giving large donations. They'll ask you what type of charitable contribution it is, and they have different limits. Generally, the main limit is you can't exceed more than 50% of your adjusted gross income. And I believe in 2021 and possibly in 2020, they loosened up that standard and you were allowed to do a larger amount.
That's right.
I don't think it's there in 2022 again.
Yeah.
But something to ask your tax advisor if you are that type of person that is making large charitable donations. And some of those have carryovers to begin with.
Yep. And those ratios are a little different if you're donating appreciated securities than if you're donating cash.
It's well worth the phone call if you're making a large donation. Well worth the phone call to your tax advisor.
I just went to the next slide. Yep.
So this is an example of a single filer. So in this one, we're showing you that itemizing benefits them. They've got the SALT deduction, mortgage interest, the charitable contributions totaled $16,500. They compare that to their standard deduction. They're going to itemize in this example. So basically, in the earlier example I gave, if they had $100,000 of wages and now they're itemizing, they'll only now have taxable income of $83,500. Again, I'm simplifying it. No other deductions, no other income sources, but fairly straightforward. But that's what itemizing means. And what's interesting over the last few years, when we're talking to people and we ask them if they're itemizing, most people say, oh yeah, I'm itemizing. And then they tell us how much their mortgage is. And
how much they give to charity, and
they're probably not itemizing under the new rule, and they're still spending all that time telling their accountant, or adding up all the deductions, all the charitable contributions, and they may be nowhere near the thresholds. They might save a lot of time if they know they're nowhere near it, when they're preparing their taxes.
All right, so ready to shift gears to credits.
Yeah, so this is fairly straightforward, just listing the main credits. And so you'll see child tax credit, family tax credit. We talk about those on the slides coming up, but the reality is the software does it automatically. So you just list your dependents, you list their ages, it'll tell you how much you qualify, it'll automatically factor in the income limits on all of those. Child dependent care credit, fairly straightforward. If you've got two people in a household, or actually a single parent, you can actually write off some of your child care expenses. EV credit, this is one that's changed this year. It has been dramatically expanded. A lot of it will take effect in 2023. In 2023, for the first time, they actually have allowed you to take up to a $4,000 credit on a used electric vehicle. I believe Tesla had phased out of the tax credits because they had sold way more cars than were allowed under the old law. But I believe the new law basically allows Tesla now to qualify for the tax credits. Again, there are some rules. Not all companies can qualify for it. I believe it had to be manufactured in the US or a certain percentage of the car. And at one point, I believe they had thrown something in about had it been done by union companies, but I thought that got kicked out. But I will say this, if you're buying an EV, the salesperson will always bring this up with you. They'll show you exactly how it works. They're really well versed in it. If you adopted a child, there's an adoption tax credit. We had a number of questions on education credits. If we had a few people said that they're going to have kids going to college next year, are there any tax breaks? So there's the lifetime learning tax credit and the American Opportunity Tax Credit. American Opportunity Tax Credit is for undergrad, and it's up to a $2,500 credit, maximum 4 years per student. And the lifetime learning credit is for undergrad, grad, non-degree, vocational schools. So that's a separate credit, and I think that's up to $2,000. Again, your software will calculate that.
They phase out, right,
And
based
it'll
on
go through the
income.
phase outs.
Yeah.
Home-related tax credits, there's residential energy credits. So, if you did some work on your house that was energy efficient, you can just go through the rules of what qualifies. And I have a house that has geothermal. I didn't put it in. The prior owner had put in. It has what's called geothermal heat, which is a high efficiency heat. I had a heat pump go out, and I remembered, oh, I could possibly get a credit for this. And it turned out I got a 26% tax credit for the price, for the cost of my heat pump. And then in the state of Maryland, they gave me, I think, $500 also. So it was kind of interesting. So you not only look at the feds, you want to check to see if your state offers any tax benefits if you're doing anything.
Solar panels are probably the more common version of that these days. Yeah.
Fairly substantial credits, without a doubt. So something to take a look at. So we talked about this, the child credit. That really the thing to focus on here is just where the phase outs are. So the modified adjusted gross income, a little play on what's called adjusted gross income. So they do a minor modification to it, but it's $200,000 for single filers, $400,000 for joint filers, and it phases out when you exceed that $200,000, $400,000 limit. So again, the software will do it for you automatically. And I believe they actually reduced this credit in 2022 versus 2021. So, I think legislation just never got passed. Again, whether they come back and do it, it'd probably be very difficult now with a split House and Senate. Generally takes one party to get it through, if that was what they wanted to get through. Next slide, we've got the family tax credit, same thing, same income limitations. It's a smaller credit, and they'll list the example for other dependents on this credit, like how they will qualify for it. Next one is student loan deductions. So this is an above the line deduction. So it's before you get to your adjusted gross income, so you don't have to itemize to take this. So if you've got student loans and if your income is below these limits, you can actually deduct the amount you pay. There's formulas on who gets to deduct it. So you want to go through all of that, but fairly straightforward. And for people with student loan debt, I know that if they had undergrad loans, I believe most of those loans didn't accrue interest and don't accrue interest for all of 2022, but will start accruing interest in 2023. I think on January 1st, I think they're going to start accruing interest again. But a lot of the grad school loans actually accrued interest, and if you paid payments on it, you can actually deduct it if your incomes were below these thresholds.
All right, let's talk about one of my and our kind of favorite tax planning savings tools, health savings accounts. So if you're eligible, and so to be eligible, you need to be enrolled in an HSA eligible health insurance plan. So a high deductible health insurance plan, and there are IRS guidelines as to what the minimum deductible needs to be for a single person, or if it's a family plan. And then if you are enrolled in a high deductible health insurance plan, then we would highly encourage you to look at and most likely fund a health savings account, or HSA. And these are the contribution limits for 2022. So if you're a single person on a single, you don't necessarily, you can be married, but if you're on a separate or on your own single health insurance plan, a high deductible health insurance plan, you could save $3,650 into your health savings account. And then where this is relevant to today's conversation is it's triple tax free. Three tax benefits. You get a deduction for contributing to the HSA. So think of it as similar to, the money you put into a pre-tax IRA or your pre-tax 401k contribution. It helps reduce your taxable income. And then again, similar to an IRA, when it's in the HSA, any earnings, interest you earn, or if you invest it and it grows, it's all tax deferred. You don't pay any taxes on it while it's in the HSA. And then distributions come out tax-free so long as they are used for qualified health-related expenses. And there's the IRS publishes, what qualifies, but it's pretty darn broad. A lot of things qualify as health-related expenses. So to get that triple tax-free benefit, so it can be a really valuable tool on kind of the one end of the spectrum. A lot of times, younger workers, healthy, don't really go to the doctor much, don't really have any prescriptions, so it can be cost-effective to pay the lower premium for a high deductible health insurance plan. And then if you have the cash flow to allow for it, fund the health savings account. It's right there kind of on that baseline of what we call our hierarchy of financial needs, right there with an emergency fund, right? You can get money into the health savings account, kind of builds up your health related kind of emergency funds. And then we encourage folks to not spend it if you can, right? So if you have some co-pays or have modest kind of medical related expenses, try to pay those out of pocket, just out of your regular cash flow, and let the money in the HSA stay in the HSA and grow. And hopefully, knock on wood, you never have a medical emergency where you need to tap into it. And if you fast forward all the way to age 65, then it basically becomes a supplemental retirement account. So it becomes like an IRA at that point, to where you can pull it out. You can still pull it out for health related expenses and it comes out tax free, or you can just pull it out for anything and it's just and the earnings is taxable as income like an IRA.
Wouldn't be advisable to pull it out unless you needed the money.
Sure.
Is that correct?
Yep. Yeah, and I should note that we're painting a quick picture here. We actually have a whole separate presentation just on health savings accounts. Have some other materials if folks are interested in wanting to dive deeper on that. But definitely a really great foundational kind of tool for deferring taxes in any given year if you're eligible. So it was drawing the analogy to just retirement savings. And we get asked a lot, hey, my income's been going up and I'm paying more taxes than I like. How can I reduce my tax bill? And here's where we always start. Well, are you maxing out what you're eligible to contribute to, whether it be your 401k or 403b, employer sponsored retirement plans, IRAs, of course, distinguishing the pre-tax contributions to traditional IRAs and 401ks, right? Because your contributions, and here you can see the 2022 limits for each of these different kinds of accounts. But a traditional contribution goes in pre-tax, so it will reduce your taxable income in that year. Roth contributions don't or will not reduce your taxable income because those contributions go in after tax, right? And then, of course, as many of you I'm sure know, the difference then is in the back end, when you draw money out of the Roth, it'll come out tax-free, versus when you draw money out of the traditional IRA or 401k, it'll be taxable at that point, right? Because it's never been taxed.
So Jason, on the pre-tax IRA though, if you're in a qualified plan, you may not be able to deduct the IRA though. Just wanted to point that out.
Based on income limits.
Yes.
Right. Yep. Yeah. No, absolutely. So and similar, the IRS has income limits for a lot of different things, right? We've been talking about phase outs for a lot of different things. And so you can always make non-deductible contributions to an IRA if you say, hey, I just want to get more money into my retirement account, but you may not be able to deduct it on your taxes if your income is above certain thresholds that get published every year. And for Roth IRAs, similar idea. There are phase outs for the eligibility to contribute to a Roth. Now, we've worked with a lot of clients to do what are called backdoor Roth contributions, a little more complicated. It's sort of a multi-step process, but there may be a way to get money into a Roth if you're above these income thresholds. But the key thing to note there is you really can't have money in an IRA already. If you have retirement accounts all through employer-sponsored plans, then the backdoor Roth strategy can be a really great strategy. But if you have money in an IRA, don't just dive in and try to do the backdoor Roth contributions, because it may not work the way you think.
So one thing for 2023, all these threshold numbers you see, they've actually gone up. The IRA is going to go to 6,500. The catch up will still just be 1,000, but for the 401k, it's going to 22,500 next year, and an extra 7,500 for the catch up, so 30,000. Though Alex on the 401k side let me know that he heard there's pending legislation for 2023 that might force people that do the catch up contributions in 401ks. They might force that to automatically go into a Roth, meaning that they can't deduct it.
It's kind of a fascinating new move, but those increases are the largest increases that we've ever seen in the contribution limits for IRAs and 401ks.
And it might end up meaning that they don't go up for a while after that, if we end up getting, I'll call it, back to a very low inflation or even a deflationary period after we get all the supply chain issues cleaned up.
So we're big fans of Roths, and Roth conversions. So Alp, you want to share a little bit about?
So this is fairly straightforward. So a Roth conversion is basically taking some of your pre-tax account, whether it's an IRA or a pre-tax 401k, and converting it into a Roth. The act of converting it is a taxable event. So if you've got $500,000 in a pre-tax 401k, and if your 401k plan allows for conversions, and you might say, okay, I'm going to convert 50,000 of my 401k into a Roth, so it'll count as a taxable event in the year that you convert it. And the benefit for doing it, and we'll talk a little bit more on the next slide, is you can potentially do it in a down market. And when you convert the money, it's taxed on the date you convert it. So if you went back to 2008, when the bear market then was down 50%, if you made a conversion at the lows of the market, the growth in the account actually came back totally tax-free. So it's a unique possibility, I'll say, in a deep bear market. What we've experienced so far, I'm going to say not many people have done Roth conversions because they don't know if we've seen the bottom. But the key considerations, you just compare your current bracket, your future tax bracket. So if you know you're always going to be in a high bracket in the future, and you're in a lower bracket now for whatever reason, you might want to consider doing a conversion. We talked earlier, if you've got nursing home expenses, it might make sense to do a conversion because you might have zero taxable income or $50,000 negative taxable income. You might be able to take advantage of that negative and also go through some of the lower brackets and say, you know what, it makes sense to convert and only pay 10 or 12% tax. We call it a little bit of tax diversification. So it gives you the ability to access some non-taxable cash in retirement. That's one of the benefits of having a Roth account. It's also really beneficial the younger you are, if you can convert or have money built up in a Roth account. So you might have 30 years where it can grow totally tax-free. And we'd also say if you don't need the money, so if you've got enough assets and the only thing you're ever going to take out of your retirement account is the forced RMD, what the government says you have to take out, in those examples, it might make sense to do a conversion. And probably my favorite way to do it is if you've happened to retire and move down to Florida. So now you can actually convert in a state that does not have a state income tax. It makes it really beneficial because you might have put all that money in your retirement account while you were working in a state that you paid state income taxes. Now you move to Florida, you do your conversion, no state income taxes. Really good deal. It's also a good deal for people that retire early and don't have a pension. So if somebody retires at age 63 and they're not taking any money out of the retirement accounts, it's really advantageous for them to consider doing the Roth conversion before they're going to start taking their RMDs out at age 72. So I know we've thrown a lot at you. It's fairly complicated, but a lot of planning opportunities.
And it really is a year-to-year planning opportunity, right?
Absolutely.
What is your 2022 taxable income from distributions from IRAs, from income from work? Have you started Social Security yet, right? Do you have any pensions starting yet, and so forth? And maybe it's going to be different in 2023, right? So it's a year-to-year kind of strategy to think through. And I'll just add a quick comment on kind of a number of these items come together where, so it's for some folks who are retirement ready, right? That they know that, hey, I'm good for retirement. I'm now sort of thinking multi-generational tax planning, and we see a lot of clients who will say, oh, you know what, kind of as a way of gifting to the next generation, you can always gift, right? Just give money. We're going to talk about that. But another way that some folks will gift is do a Roth conversion and pay the tax now. So you're kind of gifting the tax payment, right, of paying the tax on the conversion to the Roth, because then someday when the next generation inherits the Roth, they're not going to pay taxes on the distribution. So that is another strategy.
And to show you how that example works, I know we're spending a lot of time on this, but if somebody's a Florida resident when they do the conversion and their children are high earners and live in
California, or yeah,
when they inherit it, if they inherit the Roth, there's no state income taxes. But if they inherit a traditional IRA, traditional 401k, major tax consequences if they're living in states like Massachusetts.
Speaking of here,
Maryland, yeah. Right, California, et cetera. So this is just a kind of fun slide we threw out. Just how does your state rank on individual income taxes? And for those that are from Maryland, you'll see Maryland is, I think, 45th place, and it's better being number one. So you can see some of the low income tax states, and they look at all of it too. So you might have zero income taxes, but you might have property taxes that are higher in certain states, or sales taxes. But it's just a fun little slide. You can Google this.
Another tool that a lot of times folks will use, not only to help pay for college, it's probably the most common tool used to pay for college, is our 529 plans. But from a tax planning perspective, depending on your state, if you fund your state sponsored 529 plan, you can get a state tax deduction. All of the 3 jurisdictions around here in the DMV offer 529 state sponsored plans, and you can get a state deduction for contributing to the plan. And again, we have a whole nother presentation, a lot of materials just on saving for college, paying for college, 529 plans. But you may get that state tax deduction for contributing to your state-sponsored plan. While the money's in the 529, it grows tax deferred. And then when you draw it out, as long as you use it to pay for qualified higher education expenses, it comes out tax-free. So again, kind of that triple tax-free benefit, just missing out on the federal deduction piece of it, like an HSA has. But one of the other tips that we want to mention, and we did have a question kind of about, hey, I'm now paying tuition for kids in college. Any tips on taxes? Is even if you've never funded a 529 to date, and you're paying tuition directly to the school, we would encourage you to consider opening and funding your state 529 plan. Again, this assumes
if it gives you a deduction.
This assumes you live in a state that has a state income tax, and the plan offers the deduction. But in this all the 3 of these jurisdictions, you do. So if, say, you've got a student you live in Maryland, you got a student going to the University of Maryland, College Park, for example, and you're helping pay tuition bills. Well, fund the 529 first, so you can get the state tax deduction, then pay the college bills from the 529, rather than just paying it direct to the college. So that's a simple tip that a lot of folks just don't think about.
Sure. And if grandparents are helping out with the tuition and they live in a state that has 529 plans that are technically tax deductible, again, on the state level, it's very advantageous for them to utilize something like this too.
So another great strategy to consider for folks who give to charity is, in lieu of just giving cash, right? Like writing a check or putting it on a credit card, you can conserve your cash, and maybe you have appreciated securities, right? Think an Apple stock, right? That maybe you bought it at a very low basis. It's done well for you. It's now worth a lot more. It's not in a retirement account, right? We're just talking about appreciated securities that are in a personal, individual or joint taxable account, non-retirement account. And so if you were to sell the Apple stock in this example, you would pay the capital gains tax on it, right? And the state income taxes on it. And then you could donate the cash to charity. Well, what this strategy is simply saying, give the shares of Apple directly to the charity. And if you itemize, you get the same charitable deduction for the value of the Apple stock as if you had given cash. So you get the same value for the deduction. You avoid the capital gains tax, and then the charity, because they're tax exempt organizations, almost all charities, as soon as they receive it, they will liquidate it, sell it. They don't pay any taxes, and then they'll put it to use based on their program.
And Jason, just to clarify, you have to transfer the shares You don't sell them and say, here's
You
the
don't
money.
sell them. You send the shares directly to the charity. That's right. And
they all know how to
most
do
charities
it.
will have a a simple brokerage account to receive the shares, and then where the charity then sells it. And another strategy that a lot of folks are using are donor advised funds. So think of these kind of similar to like a family foundation, but much lower cost, much simpler. And of course, the most famous sort of example of a family foundation, like Bill and Melinda Gates Foundation, right? And what they did is kind of a combination of these two strategies, right? They took their zero cost Microsoft shares, donated it to their family foundation. Then they were able to liquidate and sell it within the foundation. So they got the tax deduction, sold it tax free, and then they're pursuing their philanthropic goals through their foundation. So same idea. You can contribute appreciated securities to the donor advised fund. You can contribute cash to your donor advised fund. And this is a separate account that you would open, the donor advised fund. You can call it the Alpen Karen donor advised fund. And then you get the deduction for contributing to the donor advised fund, same as if you'd contributed direct to a charity. And then from the donor advised fund, you can distribute to the ultimate charities that you want to support, but you don't get an additional deduction when you send the money out of the donor advised fund. You get the deduction for contributing to the donor advised fund. Much, as I mentioned, much lower cost, much simpler record keeping than a family foundation. And with us, for example, it's just an additional account like all your other accounts. You see it listed on your statement and so forth. And here's kind of a simple follow-up to that. Tax year 2022, if somebody says, hey, I typically give $10,000 a year to charity, but you've gone through the analysis and you say, gosh, I'm not going to itemize, all right? Even with the 10,000 and my limit on the SALT deduction, maybe my mortgage is paid off, and you look at it and you compare, like, I'm just going to take the standard deduction if I only give 10,000 to charity this year. Well, what some folks will do is say, oh, you know what? I'm going to front load multiple years worth of my planned charitable giving, right? Like I know I'm going to give 10,000 a year for at least the next 3 years. So do 30,000 into your donor advised fund now. That way you get to itemize and get the full value of the charitable deduction. Then you can always send the money out of the donor advised fund to the charities in the same pace that you've always done it. In this example, 10,000 a year. You're not required to send money out of the donor advised fund. So this can be a really valuable tax planning strategy for folks who no longer itemize but have future charitable giving intentions. And this is especially true if you're nearing retirement, you're in high income years, hey, I want to continue to contribute to charity when I'm in retirement, but the value of the deduction is not going to be worth as much when I'm in retirement and in a lower tax bracket. So we'll see, for that same reason, folks kind of front load multiple years worth of charitable giving to their donor advised fund in their high income years. And so lastly, kind of on this front, another really valuable way of giving to charity is once you have reached age now 72 for required minimum distributions from your retirement accounts, IRAs, rather than taking the required minimum distribution, having it be taxable to you, and then giving money to charity, you can simply say, send my RMD directly to the charity.
Or a portion of it.
Or a portion of it. Yep. You can do your entire RMD up to the IRS limit of $100,000. Or you can say, hey, if my RMD is $25,000, $30,000 this year, but I want to send 10,000 of it to the charity. Well, then in the 30, if your RMD is 30,000 and you sent 10 of it to the charity, you're only going to pay tax on 20,000 of the RMD in that year. So again, a really great way of lowering your taxable income in your retirement years when you're subject to required minimum distributions and may not itemize. So this way you still get the tax deduction.
And just a simple note to remember, if you do this strategy, your 1099 will still show the full RMD. You only tax yourself on the amount that you actually took yourself. So if your RMD was 30,000, you gave 10 to charity. So in theory, you should only tax yourself on 20. So you actually have to make that adjustment.
It'll be a little confusing the first year you do these. So that, good tip out. Yep. And then we hinted at gifting. So just in 2022, the annual gifting limit increased from 15,000 to 16,000. And all that really means is that if you give someone $16,000, no one pays tax on it, and there's no gift tax filing, right? Up to $16,000. And if you give, and for married couples, right, it's 16 per person, right? So 32,000, and you can do that per child, per grandchild, and so on. If you gift above 16,000 to any one person, again, no one pays tax on the gift. It's simply a tax filing. You file a gift tax return to account for the amount of your lifetime exemption you're using by gifting above the annual exemption. And this year, per person, the lifetime exemption is a little over $12 million. It's going up to almost $13 million next year. So again, for most folks, that's a non-taxable event. If you gift even above it, it's just a filing that you're supposed to do.
So the only advantage of bear markets is you potentially have some tax loss harvesting you can do in your taxable accounts. And so I'll be quick on this because I know we're kind of running up on time.
We just got a couple more slides, folks. So thanks for sticking with us.
But essentially, if you've got an investment you put, and this isn't taxable accounts, if you put 15,000 into something, it's now worth 11,000. You can actually sell it and take that tax loss in your taxes. You can recognize losses to offset capital gains, and you can actually go what I'll call 3,000 in the hole. So if you had, 10,000 of gains, 16,000 of losses, the 10 offsets, you've got an extra 6, you can use 3,000 of it against your ordinary income. The excess 3,000 will get carried over into the future years. There's also something called a wash sale rule. So if you have a position that you actually like, but want to take advantage of the tax loss, so you might have bought it at the peak of the market in January and it's down 50% right now, you can actually sell it as long as you're out of it for 30 days. You can buy it back on the 31st day and you're fine. You can actually write it off. If you buy it back before 31 days, the loss is disallowed. And you can do this on cryptocurrencies. The only thing I know on crypto for now, since there's no regulations, I believe there's no wash sale rules at all on the cryptocurrencies.
And you probably have a loss on it.
Without a doubt. So when it comes to just normal tax strategy ideals, we're summarizing here. When 401k, 403b, you've got another month to load that up if you're not already at the max for the year. Mortgage prepayments, this is something that I do every year. I'll actually pay my January payment in mid-December to make sure it gets credited during 2022. And so I just basically have pulled forward the deduction each year. So I'm still just getting 12 payments since I've done it every year. Roth conversions, you have to do it by the end of the year, and all the other things that are listed there. IRA and SEP IRA contributions, you generally have up until the due date of the tax return, April 15th, 16th, or 17th, whatever day it is, depending on if it falls on the weekend.
In the calendar. Mm-hmm.
Regular IRA can't be extended. SEP IRA, since it's related to business income, you generally can extend that with an extension. Other tax strategy ideas, you can defer income if you think you're going to be in the same bracket or a lower tax bracket. You see businesses do this a lot. They may not send invoices out, in the middle of December because they don't want to get anything in by the end of the year. And you can also accelerate deductions. A lot of times you see that with businesses. They might do a lot of year-end buying, like new equipment, because they've got more profit than they want to pay tax on, and they're going to buy equipment next year, so they just accelerate it. Jason, I don't know if you want to talk about the mega back to a Roth or.
Yeah, just quickly touch on this. For folks that are still working, enrolled in the 401k plan, this is starting to roll out more and more, where 401k plan providers are offering the ability to contribute after-tax contributions to your 401k, and then within the 401k plan, convert to the Roth bucket inside the 401k. And so this is often referred to as a mega backdoor Roth, because you're able to get more than just the $7,000 $6,000 or $7,000 limits in a regular just Roth IRA. You can get more than that, and potentially up to
a lot of money.
There's limits when you add up how much you've contributed, how much an employer has contributed. But I would just note that hey, if you're someone who's still working and you are maxing out, you're hitting the limits plus a catch up if you're over 50, and you're saying, I've got additional money that I would like to try to get in retirement accounts, call us. Let us know. We can kind of walk you through to determine if a mega backdoor Roth is available to you and makes sense.
Yeah, so it's part of the plan generally would tell you if it has it available, and they usually have some fairly fancy literature to explain actually how it works.
Well, we've seen some that are very confusing.
That's true.
Folks log into the site and you got to dig to find out, oh, is it offered? How does it work? And then inherited IRAs. So if you inherited an IRA from a non-spouse, right? So maybe a parent passed away or a sibling, and you received an inherited IRA in the last 2 years. Just in the last month, the IRS has come out with some updated rules related to those IRAs and the required distributions. And so just the quick synopsis there is non-spouse inherited IRAs since 2018 have to be distributed within 10 years. Okay.
2020 possibly?
Well, no. The 10-year rule went back.
2018,
right?
Okay.
But then what's new is each year now, starting in 2023, you are going to be required to take a minimum amount out. Each of the last 2 years, you were not required to take any minimum distributions out. So the strategy had been, just defer it and take it out as you please over the course of 10 years. New rules just came out. For anybody who we work with who has an inherited IRA from a non-spouse, we'll make sure it all happens for you in 2023. But if you have one that maybe you kind of manage yourself, just be on the lookout.
Yeah, so this was an IRS clarification. It caught a lot of people off guard. And I'll say that they're giving people a free pass on the years that technically they believe it should have happened. And so this came out in October, but they said we're not going to have it impact 2022. As Jason said, it's a 2023 issue.
So I know we covered a lot, so thanks for sticking with us. This is being recorded, so we will send out a recording and the slides to anybody who would like it. We also post all recordings and a lot of the materials that we reference, whether it be related to health savings accounts, qualified charitable distributions. We've got a lot of infographics and blog posts on our website, so please feel free to pursue that or just email us and say, hey guys, do you have a piece on any of these subjects? Happy to share them with you. And as we started out with, don't hesitate to reach out. Here's our great team. I'm happy to connect with any of you, and appreciate your time today. And be safe. Take care. Happy Thanksgiving to everyone.
Take care.